What's your interest rate forecast at this point, given everything we just heard, of course, and the move down in yields that we've seen dramatically over the last week?
Well, we had adjusted our expected range down to 175 at the low end. Now, that was prior to the events of the last couple of days. And so we may have to adjust it down to 150 or even 125 if this persists.
What is the if?
If this trade war escalation persists.
125?
It could be. That's sort of a worst case scenario for us. We really came into the year expecting 175 to 2% to hold. But it looks as if this persists, if it continues to ratchet up, if it continues to weaken confidence on the part of, businesses that stop investing or are reluctant to invest, then it could get worse. But our base case scenario was 175 on the downside, so we're here. We're
right here now, although we're going to get a couple of cuts, conceivably, from the Fed?
Well, presumably, if the Fed is doing its job and it's working, you actually should see the yield curve steepen, right? And we started to see that with the last rate cut, that initially the yield curve steepened a little bit, and saw long rates actually move up from about 2%. That, of course, has all been undone in the last couple of days.
Ashok, when we see these, stunningly low yield levels and big drops, how do, as an equity investor, whether it's a scary move about growth and where we're headed, or whether it's an opportunity to buy stocks that are paying much higher dividends than you're getting in yields in the bond market?
Yeah, good morning, Sarah. I think, this move in rates to lower rates, it's obviously had a component related to the China tariff issue, but the other two, important dynamics have been decline in inflation expectations, that I think Steve was just talking about how the Fed is going to in responding to that, and also the move in European rates. The move to lower Treasury rates is started with the move to even further negative rates in Europe. And ultimately, those two things, I think have a larger component of inflation and following the foreign markets than a really dire outlook on the growth front. And those are things that ultimately, it won't be immediate, but those are things that support risky assets. That includes equities, includes credit-oriented fixed income as well.
Ashok, in a market like this, you're talking to your PMs right now, particularly those who actually have a credit focus. What are you telling them in terms of finding value in fixed income market right now?
Yeah, it's hard. With a lot of Europe at negative yields. We have a couple of things we think are going to end up playing out. First, foreign investors. They've been an important component in the U.S. bond market for years, but the low level of rates and relatively attractive credit spreads in the U.S. compared to a lot of other markets, we think we'll see foreign interest in U.S. fixed income and in the credit markets continue to start increasing again. And I think second, where we're seeing the most relative value right now is a couple of months ago, it was really oriented towards the floating rate instruments, the bank loans and the CLOs, areas where investors have been exiting because of concerns about, the Fed easing cycle. I think those represent value, but increasingly, particularly after yesterday, the high yield market is looking more interesting to us as well. And I'd expect, over the pretty near term, we'll start deploying some capital into U.S. credit markets as well.
Kathy, after the escalation in the trade war into the currency space, is it too alarmist to think that China could sell its Treasury holdings, or that would actually be a place that China would go as a retaliatory tool?
It's called a nuclear option for a reason. Because
I mentioned it. Jim Cramer didn't like that.
It's bad for everybody at China as well as the U.S. So I don't think, especially given their efforts last night to sort of mitigate the decline in the currency, I think the messaging here is they're not trying to go to that extreme. And they have, I think one of the big issues that people don't talk about is China has a lot of U.S. dollar denominated external debt. So if they were to sell a lot of treasuries, drive down the dollar, that drives up their cost of servicing that debt. So there's a lot of reasons why they wouldn't want to go there. You can never say never, but it seems very doubtful.